Hello, this is Jeffrey Cohen, Chicago Quantum. How you doing? We're here to talk about dividend stocks. We ran our Chicago Quantum net score up run, and I'm going to share with you some insights, and more importantly, I'm going to share with you the 4 dividend stocks that you should look at potentially buying today. So let's take a look. So the first thing you have to do is you have to run the whole model. You have to figure out where's the S&P 500. You see this on the screen here. I'll try to make it a little bigger for you. Where's the S&P 500? You know, it's the 29th best stock in the entire stock market that of stocks that made a profit. That means there's only 29, because it starts at 0, stocks that are a better risk return than just putting your money in the S&P. In fact, number 22 is the QQQ, which means, and by the way, these have never shown up this high in the list. It means that in this time of market tumultuousness, you want to think about just going back to ETFs, going back to the indices. The indices are there for a reason. And so now we're going to talk about the dividend stocks. So the dividend stocks are Blackstone. Let's start with Blackstone. We've talked about this one before. Blackstone just is a hair above 0 in terms of the Chicago Quantum net score. Just a hair. These are not like amazing risk return improvements. It's a really tough market right now, so you're looking at 1/10,000th better than the risk return of the overall market. But you take it, right? Maybe it's a couple of basis points. It's paying a nice 3.54% dividend. Variance it's not low, but it's not that high either. It's trading at 101% or 1% higher than it traded last year on average. So it hasn't moved. Blackstone hasn't moved in a year. That's weird. That's weird, actually. And the volume is down 72% of daily traded volume yesterday, then for the whole year, 253 trading days. So volume's a little light. I guess people aren't that excited about the money managers. And we're going to talk a lot about the money managers because I think there's something to talk about here. So the next company is the Carlyle Group. Carlyle Group, my God, I used to work for a money manager, a big one, and Carlyle was the second big one. We used to joke around about them. But they pay a 2% dividend. Their variance is very low. Their shares must be somehow tightly controlled. They're at an 8% discount than what they traded last year. And this is interesting, only 48% volume. So half the volume is last year, so no one's really looking at them. The third is Artisan Partners. They just manage money. 8% dividend is amazing. Variance is tiny. It's actually lower than Carlyle. It's down 16% versus last year. And in fact, its volume is also down. It's trading 76% of last year's volume. The last stock is Qualcomm. Qualcomm broke a lot of hearts. This stock moves, right? It's trading, it's 110%. You know what? Let me lock in the freeze the header row so you can see it. Qualcomm's interesting, right? It's got an 11% expected return for a growth stock. Volume is up 10% over last year, so I think you're going to find something about semiconductors as we talk, and IP-based companies. It's down 6% over the year, so I talk about breaking a lot of hearts. This thing's gone up and down like a yo-yo. 252% is the normalized variance, which is much, much higher than the money managers. And it's not bad. It's paying a 1.81% dividend. They do generate a lot of cash. It's a very healthy company. So 4 stocks. We could end the video right now, but we're not going to. So you could say Blackstone, Carlyle Group, Artisan Partners, and Qualcomm. Jeff, hey, thanks a lot. By the way, how would you have done if you would have bought these stocks yesterday when the market went up? Let's take a look. You would have made money. A lot of money. 3% for one, down 0.6 for the other, up 3% for the next, and up like 2.7 for the next. So up 3 minus 1. It's not bad. You would have made 2 points in a day. That's more than the dividend almost. And so that's interesting. Now there's another set of stocks I told you guys about, and this required a lot more homework. And I'm going to share a little bit of methodology for my friend in Virginia, who's always asking me, "Hey Jeff, talk about methods." So I went ahead and I looked at stocks. I probably should even type the method up. And the first thing I looked at is I looked at stocks that had fallen in the past year. And this is anywhere from 35% to 65%. So obviously, stocks that are falling like that, right, they're either a bargain or they're going out of business. I don't mind. I'm a value investor. Let's take a look, right? The second is I want, well, of course, it's U.S. listed, trades every day. Oh my God, it passed data validation. They are profitable. Positive net income. But in this case, the efficiency is worse than the S&P 500. Dividends are higher than the spider, S&P 500, and they've fallen. And then we do a proprietary... Darn it, Jeff. I thought you said this was easy. It's not easy. I had to read all the financial statements. I had to look up the companies. By the way, I'm so sick right now. I couldn't sleep. It's been 2 or 3 days. I think it's just a cold, but I don't have a fever, thank God. But stomach hurts, head hurts, everything hurts. Can't sleep. It's awful. But the model didn't sleep last night, which is great. So it's proprietary due diligence. And I'm going to share with you what we found. We found 6 stocks. 6 stocks that we talked about yesterday or day before. And if you would have invested in these 6 stocks, you'd have made a friggin' boatload of money. Boatload. Do I have a boat? No. You would have made, you're going to love this, an Australian Dundee hat's worth of money. That's a lot of money, right? Foot Locker, you'd have made 2.5% yesterday. Rent-A-Center, 2%. American Eagle Outfitters, 5%. Flex Steel, they make furniture, 2.5%. The Gap, who hasn't heard of The Gap? In fact, I've bought a lot of Old Navy, 2 pairs of jeans this past weekend. And Q-Rate Retail, which we had looked at and panned at like $12 a share. But I got to tell you, at $4.30, $4.40 a share, yeah, looks great. So these are our dividend. I call them divvy and down 40%. And so I don't know if I'm going to put money in it, but if I had money to just drop into the market for a rainy day, these are the kind of stocks I would look at. So I'm going to share with you. So again, just for, hang on. Just so you know, I want to make sure you know who they are. Foot Locker, Rent-A-Center, American Eagle Outfitters, Flex Steel Industries, The Gap, and Q-Rate Retail. These are much higher risk portfolio stocks that pass due diligence. They've fallen in the past year. Their dividends are high. By the way, each one has a story. Each one has a problem. And that's why you hire Chicago Quantum, is to walk you through all the details of making that investment decision. The 4 absolute no-brainer dividend stocks: Blackstone, the Carlyle Group, Artisan Partners Asset Management, and Qualcomm. Because these are much more efficient. When the S&P 500 goes up, these guys go up. Much lower risk while still preserving your return. So that's the dividend story. Now I want to talk to you about some insights. So the first thing is, don't get this cold. That's the first thing, right? Do not get this cold. Maybe I'll share with you something else. It's so interesting, this dividend stuff. So when you look at the QQQ, the IWM, and the spider, the variance of the spider is still very, very low. When you see 9 times 10 to the 5th, the variance of all the money-making stocks tends to be 10 to the 4th. So it's not quite 10 times better, because it's probably like 1.1 times 10 to the minus 4th versus 9.0 times 10 to the minus 5th, but it's better. So the spider, the S&P 500 index ETF, has a better variance play for you. If you're not watching stocks every day, if you're not in the market, S&P 500, or now the QQQ does even better. And this isn't even really a stock picker's market, because most of the stocks are less efficient than the S&P. You have to really work hard. There's like 30 stocks to look at. And by the way, I have so much to share with you. It's awful. So the actual S&P 500 return in the past year, excluding dividends, is 8.82%. That's not bad. I mean, they always talk about the power of 10% compounding, right? If you had invested in the Russell 2000 small caps, you would have lost 9.35%. Now, I know my small caps are down, so I get it. What's surprising is QQQ. So this is the NASDAQ 100 composite. These are America's finest growth stocks. Only up 3.42%. You know, I'm earning 0.6% in my CIBC or Marcus, Goldman Sachs, or Wells Fargo, whatever bank account I have, right? 0.6. I'm almost going to meet the return of the QQQ for the year with a bank account. So we have a model, and so the market return that we estimate for next year is 5.72% return, inclusive of dividends. I want you to know that's really bad. That's a really bad return. All right, what else can I show you here? Here we go. So, please stop. So I wanted to show you the risk of the overall market. By the way, we do a Koleski decomposition on our matrix to make sure that our matrix is valid. Look it up. It's a NumPy, linear algebra formulation, to make sure that our matrices are solid. So a little technical stuff for you there. The expected return of all money-making stocks, all positive net income, is 6.33%. So the good news is, just by buying stocks that have positive net income, you've already boosted your return 1%. The other thing is that the all-stock variance for money-making stocks is 1.2 times 10 to the minus 4. It's worse than the S&P. So it's partly why this model works. So now we're going to take a look at what happens if you didn't do the proprietary due diligence. Okay? And all you did was sorted, which is easy, right? Oh, who lost the most money last year and who paid the biggest dividend, right? I'm a hero. I got money losers with a big dividend. Ugh, everything's a discount. It's like I'm going to Dollar Tree and I'm paying 50 cents, right? But it's not the case. You can see these are red. Let's blow this up a little bit so you can see it. So this is the not due diligence model. First thing you look at is Mega Matrix Corp. Now, we made a video on this company because they changed their name. They're very sneaky. Out of China, Aerocentry, aircraft leasing. And now they're doing some video game where you can earn Bitcoin, I think. But when we looked at the website, it got a 401 error. I'm just saying. So, the stock's trading at 32% of where it was last year. Paid an 11.8% dividend, but that's because they spun off like $1 a share to holders of record of the legacy business. Pineapple Energy, just a stupid name. I didn't even look them up. Loan Depot. This one I spent a lot of due diligence on because it's a healthy dividend. It's a healthy business. They're a real estate mortgage licensee. So they initiate mortgages. You go into a store, oh, I'm buying a house, I want to refinance, hook me up. Do you know that 90% of their income, $3.3 billion of revenue comes from selling you a mortgage for more expensive than it should be. That's the most disgusting business model I've ever heard of. So here you are, you're going to buy your first house. Or, you're young. You got your little down payment. You're just trying, right? You want to do it. You want to get the American dream, right? Or you want to refinance your loan because maybe you're going to lose the house, right? So what they do is they sell you a dollar for $1.20. Oh, Mr. Cohen, that'd be great. I could offer you that loan for 3%, but you look like you can afford it. I'm going to charge you 5%. Okay, so here's the problem. They made a good living doing this, but with interest rates going up, I don't see refinancings doing very well. So I'm going to show you how I know that interest rates are going up. Type in FINRA Morningstar. I just do FINRA because it shows up. I saved it. FINRA has market data. FINRA-markets.morningstar.com. One of my favorite pages. FINRA is the organization that manages our investment advisory license, so I trust them. Okay, let's look at bonds. Let's take a look at government rates. So the government rates are in red, the last close. And you see it's healthy. It's up. The 2-year money. So if you had a real short mortgage, right? We used to be at basically zero. Now it's like 2.5%, 2.37. 5-year money's at 2.66, 10-year, 30-year. If you just look at the 10-year note, you see how it went up, dropped. COVID. Stayed low because they kept it low. And then very quickly the 10-year money came up. So all this talk about the Fed not doing anything, the Fed's doing something. It's right here. So you look at all this and you think, all right, so interest rates are up. And in fact, one of the things that I worry about is LIBOR and variable loans. So a bunch of companies we looked at, they borrowed a lot of money. And they borrowed the money at a variable rate. So when interest rates go up, like they have here, look at that peak. Even 3-month money is 75 basis points. It used to be 0. So if you're a regular company and you're triggered off of 3-month money, you're paying 0.75% more. And if you borrowed $1 billion, that's like $75 million a year. Are you crazy? And I know companies that have borrowed $1 billion. So you got to look at that. You got to look at that while you're looking at stocks. Let's keep going. So Q-rate retail, well, this one, they've had some trouble, right? I mean, the stock's down 48%, pays a really nice dividend. By the way, no promise of future dividend, but they do. They buy back stock. They're solid. They're in it for the shareholders. They had a fire. They had supply chain issues. They were running the same old crap on TV because they couldn't get new product for home and electronics. But they still did okay. And so you can buy Q-rate at a super duper discount. By the way, here's Rent-A-Center. Same type of validation we did. I'll make it green for you just to show you. There's a lot of these companies, right, that are just like sitting in plain sight. Rent-A-Center. Did you really think about Rent-A-Center when you woke up this morning? If you're like me, you bought your furniture. You didn't rent it. I used to rent my furniture when I would do projects out of town as a consultant. Sometimes we'd furnish an apartment. I get it. Sculptor Capital Management was another one we looked at, but their AUM is falling. And so here's the problem with all the money managers, right? I love money managers. I'm a money manager. I love money managers. It's great business, right? But when fixed income drops, then all your fixed income money managers, like Franklin, Ben, they drop. They have less money to manage. When equities drop, or more importantly, when people lose money because it goes up and down, then companies like Sculptor Capital Management lose. When real estate money dries up because they're tightening money supply, Sculptor could fail, or not fail, but suffer as well. So here's a nice 5.2% dividend. The stock's down 44%. Didn't make our list. Goosehead Insurance, stupid name, we didn't look at it. Betterware de Mexico, we just didn't look at it. But as we went through the other stocks, we found other ones that we really liked. We found Foot Locker. And so we had to do a lot of homework. So I guess that's part of the value of working with an investment manager is they do all the homework so that you don't have to. And so those stocks have been doing pretty well. I want to talk one last thing. And again, this is for my friend in Virginia. He said, Jeffrey, what industries are going to go up if the market recovers? Where am I? I'm not an old person. I'm not fishing for a 2% or 3.91% dividend, even though I love 3.91% dividends. I can tell you. Where's the big money? Where's the action at, Jeff? I want the action. So the action is in blue. Right now, these are the top CQNS upruns stocks. Lattice, NVIDIA, Axcelis, Alpha and Omega, SI Time. They make chips that tell the time. Synaptics, Applied Materials, Diodes, Ultra Clean Holdings, KLA, On Semiconductor, Lam Research, MKS Instruments, NXP Semiconductors, Qualcomm, Synopsys, Broadcom. So, Advanced Micro Devices. Okay, so just buy semiconductor stocks if you really want to kind of play the turnaround. The second set of stocks are finance companies, money managers. They make loans, or they really make investments, right? Not so much loans as investments, right? Private equity, venture cap, leverage loans, or just manage money. They buy and sell companies. So here you got Silvergate. They're a Bitcoin lender. SVB Financial Group. We talked about Blackstone, Carlyle, Artisan Partners. But you also got Virtus Investment Partners, Ameriprise Financial, T. Rowe Price, KKR, Kravitz Kohlberg, Kravitz. I remember the barbarians at the gate. Ares Management, Hennessy Capital. It's too early to be thinking about Hennessy. And BlackRock. And so the other stocks you would look at if you think that the economy is going to do just fine is you would invest in the money managers. Now, let's be honest, right? What's the risk? So the risk of the semiconductor business is inflation hits, recession hits, Christmas time comes, no one buys a computer, no one buys a toy. We buy less cars. We stop Bitcoin mining because for some reason crypto stops being a thing. Okay? So you stop Bitcoin mining, you don't buy miners anymore. Do you know Mara buys their Bitcoin miners like $1 billion at a time? And so to be honest, Bitcoin's still at 41,000. It's still attractive, right? Like it's still, you make money when you mine Bitcoin. But at some point you might not. So that's the game here is where things going to go. And so that's it. Finally, I just want to share with you something. I want to go a little bit deeper. So, Jeff, what's this chart you're showing me? This is crap. I don't understand it. It's a bunch of letters, right? It's not crap. All of these have a CQNS score of 12, minus 12. And if you compare that, it's 0 for the S&P 500. And the best stock is 7. So if you want to improve your risk-return profile, you don't just buy Lattice Semiconductor. So you do that, and you run a risk of the CEO, says something stupid on TV or makes a mistake, company-specific issue, whatever, right? There's a fire, there's a flood, there's famine. But more importantly, there's no zig and there's no zag, right? And so what this says is you have a choice. You can buy 4 stocks, 5 stocks, 6 stocks, 7 stocks, 8 stocks, 9 stocks, or 10 stocks with exactly the same risk-return profile. I want you to think about that for a minute. So what this is saying is you don't have to sit there in one stock. You could buy between 4 and 10 stocks. And I will tell you that we spent a lot of our day yesterday coding, because it's really hard to go deep like this. Can you imagine having to look at all 10 stock combinations, all 50 stock combinations, all 100 stock combinations? It's a lot of combinations. It's a lot of work, right? And so the good news is, right, when the markets aren't returning a lot of return, it's more important. This is like the so what. It's more important for you to lower your risk in the market. And the way you do that is you do that by buying a Chicago Quantum net score run. Say, hey Jeff, give me the big ones, right? Give me the good ones here. And then you think about, how can I reduce the risk of my run? And so that's where we're at. I want to thank you for listening. So it really helps us if you leave comments below, because then we can see what you're thinking. We can talk about it. We'd like to get a conversation going with you. So if you have any questions, as an example, do you know who these companies are, right? Comments below. And then please hit the subscribe button if you like this. The subscribe button helps us to be able to reach you more with videos, and it also shows YouTube that we're an attractive channel that makes content that people like. So please leave a comment below, hit the subscribe button, and I just want to thank you so much for listening. It's great, and good luck in the market today. Bye-bye.